The day Liquidity stopped answering. At first, nothing looked wrong. Screens still glowed, prices still moved, orders still entered the system. But beneath the surface, something essential had gone silent. Liquidity was no longer responding, and the system felt before anyone could explain it. To understand why this day mattered, we need to step into the unseen mechanics of modern finance. Liquidity is not money itself. It is willingness, the readiness to buy, to sell, to lend, to absorb risk without hesitation. When liquidity flows, markets feel alive. When it hesitates, everything slows. And when it stops answering, panic does not arrive immediately. Confusion does. The first reveal begins with a subtle shift in behavior. Market participants notice delays where none existed before. Trades took longer to complete. Prices widened slightly. Not enough to alarm, but enough to unsettle. Institutions checked their models. Everything looked normal, yet responses felt thinner, more cautious, as if the system were holding its breath. The second beat followed as requests went unanswered, not rejected, ignored. Liquidity providers reduced exposure quietly. Algorithms adjusted thresholds. What had once been automatic now required confirmation. Each participant waited for another to move first. The market did not freeze. It hesitated, and hesitation in finance spreads faster than fear. What made this moment dangerous was its silence. No headline announced it. No rule was broken. Liquidity had not disappeared by force. It had withdrawn by choice. The system was still functioning, but cooperation had weakened. Trust was no longer assumed. It had to be earned again, trade by trade. By the time authorities noticed the pattern, the damage was already forming. Because when liquidity stops answering, it is not asking for rescue. It is asking who will move first. As the silence spread, uncertainty replaced calculation. Institutions began treating every request as a question rather than routine. Counterparties were reevaluated in real time. Balance sheets that looked healthy on paper suddenly felt opaque. Liquidity had not vanished. It had become selective. The reveal deepened when internal risk desks issued quiet warnings. Models assumed continuous participation. They did not account for hesitation. Spreads widened further. Volumes thinned. Small adjustments compounded indivisible strain. The system was still moving, but its rhythm had changed. What once felt automatic now felt deliberate. The conflict emerged as trust fractured asymmetrically. Some institutions continued providing liquidity, believing withdrawal would worsen conditions. Others stepped back, prioritizing survival over stability. Each decision was rational in isolation. Together, they produced paralysis. Cooperation, the invisible glue of markets, began to fail. The buildup intensified as communication failed to reassure. Official statements emphasized strength and resilience. But liquidity does not respond to words. It responds to behavior. And behavior had already shifted. Every participant watched others more closely than the market itself. Waiting became strategy. By now, the system faced a dangerous feedback loop. The less liquidity responded, the more cautious participants became. The more cautious they became, the less liquidity responded. No rule forced this outcome. No authority ordered it. The market was doing exactly what it was designed to do: protect itself. What made this moment unique was its fragility. Panic had not arrived. Collapse had not begun. Yet stability depended on a single question repeating silently across the system. Who will act first when everyone else is waiting? The tension peaked when hesitation reached critical mass. A few large participants stepped back at the same time, not coordinating, not conspiring, simply responding to the same signals. Liquidity thinned abruptly. Prices began moving on smaller trades. Volatility increased without volume to absorb it. The market was no longer deep enough to hide fear. The conflict sharpened as internal alarms escalated. Risk limits were hit faster than models anticipated. Automatic safeguards trigger reductions rather than support. Systems designed to protect against collapse amplified retreat instead. What was built to absorb shock now reflected it back into the market. The buildup intensified, when normally reliable anchors failed to appear. Major institutions that usually stabilized trading stayed silent, not because they were weak, but because acting alone felt dangerous. Providing liquidity meant exposing balance sheets to uncertainty no one could price accurately. The cost of being first suddenly outweighed the cost of waiting. At this stage, the market's fragility became visible. Liquidity was revealed for what it truly was, not a resource, but a collective decision. It existed only as long as enough participants believed others would remain present. Once that belief weakened, the system lost depth without losing infrastructure. Authorities monitored conditions closely, yet intervention hesitated as well. Acting too early risked signaling panic. Acting too late risked collapse. The same dilemma faced everyone at once. Move now and stand alone, or wait and hope someone else moves first. By now, the market was no longer pricing assets. It was pricing trust. And trust, once uncertain, does not recover through force or instruction. It returns only when someone accepts risk on behalf of the system. The moment had arrived where stability depended on a single, quiet act of commitment. The turning point arrived without announcement. No emergency broadcast. No dramatic rescue. One institution quietly re-entered the market, absorbing risk that everyone else had avoided. Prices stabilized slightly. Volumes ticked upward. Nothing spectacular happened, and that was exactly why it worked. The climax was not the act itself, but its signal. Others noticed. A second participant followed, then a third. Liquidity did not flood back. It trickled, carefully, cautiously. Each trade confirmed that participation was possible again. Not safe, but survivable. The system began relearning something it had almost forgotten. What followed was not immediate recovery, but stabilization through example. Trust returned behavior by behavior, not statement by statement. Authorities supported from the background, ensuring first movers would not stand alone if conditions worsened. The goal was never to overwhelm the market with force. It was to remove the fear of isolation. The resolution unfolded over days rather than minutes. Spreads narrowed. Volumes normalized. Liquidity resumed answering. Not because uncertainty vanished, but because the paralysis broke. Participants remembered that markets function not through certainty, but through shared risk-taking. Someone must always move first. In retrospect, this day revealed a truth hidden beneath every financial system. Liquidity is not guaranteed by design alone. It is sustained by confidence that participation will be met, not punished. When that confidence weakens, silence spreads. When it returns, it does so quietly, through action rather than assurance. Europe did not avoid collapse that day because rules were strong. It avoided collapse because someone accepted uncertainty on behalf of the system. And that lesson lingered long after markets forgot the silence that preceded it. Subscribe to join the journey.